to really get the grips of things, you've got to do this kind of research on all of the variables and on all of the different patterns. So it is a lot of work. You've got to kind of love it. And you can't also be too swayed biased by your data, because sometimes overanalyzing data can make you make mistakes. Because there's intuition and there's data. And intuition and data should work together, right? But sometimes one outweighs the other and it can get you in trouble. Welcome to the Steady Trade podcast. We have myself, Stephen Johnson, the veteran Tim Bohen, and the latest newcomer, Kim and Curtin.
I'm not a veteran. I just wear all of the military gear. I wish I was a veteran, but I'm not.
But you're a trading veteran.
Yeah. Well, I don't want to be stealing. I don't want to be stealing any valor on this podcast. So.
Good man.
And I think I'm a veteran presenter. I've presented a lot of advertising presentations, but different to them, this one actually means something. So I'm quite excited to talk you guys through the importance of dollar
clients
volume.
would be clients would be real happy if
I'm never going back. But look, one of the most overlooked things in the stock market, one of the most overlooked elements or variables in the market is dollar volume. Now, a lot of people will look at volume, but few will look at dollar volume, which is why I really wanted to bring it up for all of the Steady Trade audience, because it's a huge learning. And obviously, I mean, Tim, I don't know how you calculate dollar volume, but the way I've done it and the way I work it out for this presentation is I'll take the opening price of the stock for the dollar volume on the day, and I'll times it by the volume on the day. So what did it open at? Say it opened at 5. What was the dollar volume? It traded 100 million on the day. That would make the dollar volume 500 million because it traded 5 times the 100 million of the opening. Is that makes sense, or do you have a different version?
You totally makes sense. What I do is I like to take and I do this, just top of my head, I like to base it based on what I would consider the average price.
Yeah.
So let's say this thing's, we're talking crazy runners and it went from 1 to 5. So what I would do is I would take 350 times the daily shares. That would be now again, that's how I look at it, because especially, and I see what you're doing, and listen, with any system, it's just important to have a system. But most these stocks we're looking at day to day are those big pre-market movers. So to me, that opening price, I mean, it could be anywhere on the spectrum. So if it was that crazy pre-market runner, I average and then multiply. So
okay, yeah. So there's a small difference, but the most important thing is that I want the audience to start getting in the habit of starting maybe tracking dollar volume, tracking percentage gainers, tracking patterns. And I just want to kind of talk you through a presentation of how I've looked at dollar volume through a specific system and found some pretty, for me, it's some pretty incredible results. It would have kept me out of, what was the ticker today?
ITRM, yeah.
It should have ITRM, right? It would have kept me out of that, and it did keep me out of SPI, and it's great, and I've spotted some really good long opportunities with the likes of Kodak and McRib, MCRB, and a few others. But I just want to, like I say, we'll not go on about it too much more, but I just want to show you the importance of not only volume, but dollar volume in the market, because when the demand outweighs the supply, we start seeing crazy shit, right? When there's so much demand, and by demand, I kind of look at demand in terms of volume. I know there's shorts as well as longs, but I look at demand as in volume. When there's so much demand and there's only limited supply, which in terms of is the float, and how many shares are tradable on that day, including the institutional or insider traders. What happens when too much demand outweighs supply? And the results are quite statistical, quite telling. I must have tracked a good couple of hundred stocks. So it's not like it's a small sample of like 10. I mean, some of the samples have got like 6 or 7 because there's such outliers, but tracked a couple of hundred and the results are quite interesting. So I'll just
I still remember one. I still remember one of my favorite quotes of yours. You know, I always say, you know, only price matters at the end of the day. Only the price action matters.
And it does, yeah.
But then I always say, man, volume. You know, if price is here, man, volume is like, it's almost like if you're racing and it's like price is like half a step ahead of volume. And one of your favorite quotes, I think 3 years ago, you said this, is price and volume are dance partners. And you have to think about that interaction. You know, you can't have a dance without both of them. So I've always appreciated that quote.
Volume and float, right? Was it volume and float or partners?
Yeah.
Or was it price and volume? But yeah, I mean, look, the prerequisite to this, or the caveat, if you like, is that this is ultimately just one variable of 10. So it's not the secret of the market. It's not even close. It's just like, it's almost the way I say dollar volume. It's a very in-depth look at dollar volume. And then maybe you need to take an in-depth look at float, in news, in sector, and then see how they all kind of, I guess, dance together. So I'm going to break it down through several different, I guess, categories and groups. And now I name the categories and groups based on how much dollar volume they've traded. So can you see the screen with Billionaire Club on?
Yep, we're good. Yep.
Cool. So the Billionaire Club is the stocks that trade over 1 billion shares in terms of dollar volume. So the way it's categorized is 100 million, $10 stock at the open, you've hit 1 billion. Anything over 100 million, you've hit the Billionaire Club. Now, in relation to the Billionaire Club, I've only seen, since I've been tracking this about a year, because you've got to remember the volume hasn't been explosive in the market, only in the last maybe 3 or 4 months since we've had this change in life and change in perspective, I guess, when all of the Robin
SRNE,
when the furloughs
I still
came.
remember, you know, I think May 15th was the day SRNE traded 500 million shares in a day, and something changed that day, because that, you know, like you said, I mean, it's September 30th, so that's what, you know, 3-4 months ago. That was like D-Day, where just the volume, just everything since SRNE on May 15th has been higher volume than I've ever seen. So,
and we don't know why that is the case. You can see maybe some of the hedge funds or some of the people who will typically trade higher price stocks, maybe they've dropped in and jumped into penny stocks. Or you can say that because of the global circumstances in the world, there's so many new entries to the market. And I know that in terms of brokers having many more clients and signups, it could be a bit of both, right? But the crazy thing about $1 billion volume, the way this is calculated, and like I say, I've probably gone back a year. If I've missed one, I'm sorry, but I don't think I have. I've only seen six or seven stocks, 7 including SPI, that have traded over $1 billion volume that I've seen maybe in the last 6 to 12 months. And I haven't seen one fail. I just want to quickly talk you through the bottom section. Do you see how it says gap go, gap hold, gap crap?
Yeah.
So gap and go means if the close in price was 10% higher than the opening price, that would be classed as a gap and go. If it closed 10% higher than it opened, so if it opened at 9 and it closed at 10 or above, or 9.90 or above, 5% or 10% above, it would be a gap and go. If it was within a 5% range between its opening price, it would just mean it held, and crap is just it dumped out. Does that make sense?
Yep.
Yeah.
Now,
okay.
Kim, remember, you jump in too, because I mean, a lot of this stuff, because I mean, obviously we know a lot of our listeners are newer, and for me, this might be, rule of thumb, as they say. So definitely jump in, Kim, if you got questions.
I don't think I understood what you just you said. Does that make sense? It does make 100% sense to me, but I'm also aware that I may not know some basic things.
But I can repeat it one more time, because I kind of double track, because I mixed it up. It's 5. So basically, if a stock opens at say $10, what I'm looking at is the closing price. So what does it close at in relation to the opening price? So if it opened at $10, there's three classifications: a gap and go, a gap and hold, and a gap and crap. The gap and go means that it closed higher than what it opened. So in essence, it went. And I class that by a 5% increase from the opening price.
So when you're looking at it, you're looking at what happened to it the day before.
No, I'm looking at what happens specifically in that day. So from 9:30 till 4 p.m. If it opened at 9:30 at $10 and it had a 5% increase to $10.50 or 60 or 70 or anything above, that's a gap and go. It went forward from its opening price in relation to its closing price. Where a gap and hold would be, it opened, it could have gone up or down, but ultimately it closed within a 5% range up or down. Okay. And a gap and crap it just fell apart. But in very simplistic terms, a gap and go means it opened and went higher. A gap and crap means it opened and went lower. And a gap and hold means it just stayed the same on the day. Do you know what I mean?
I think so.
So, Tim, and tell me if there's maybe something that I've missed here, but I've not seen a stock trade $1 billion volume and fail. Not on its first day.
I don't, here's my thing. My answer would be, I don't have that data, but by no means would I argue with you. If you're like, listen, every one of these low price stocks that trades $1 billion a day continues into the afternoon, gaps up the next day, I'd be like, yeah, makes sense. Doesn't surprise me one bit. Because at the end of the day, and I tell this story all the time, the market, ultimately, it's the stock market. It is a market. It's supply and demand. Yeah. And if there's enough freaking demand to make $1 billion of stock trade hands in some sketchy piece of crap stock, obviously there's more than 100 buyers. There's more than 1,000 buyers. I don't know what that number is, but there's got to be hundreds of thousands of buyers or several huge buyers to support that. So that's the demand,
Yeah.
And is something, Stephen, you're using for more than one day?
Say it again.
Are you using this awareness now that you've come to? Are you using this for more than one day, or
massively? Yeah. So, for example, what I will do is say I'll be able to categorize what category or criteria the stock's going to fall into based on its pre-market volume. So, say for example, if a stock has traded 20 million volume pre-market, like we saw today, and for example, just say it's a $10 stock, I'd say, look, it's getting to 9:30. It's traded 20 million in the pre-market. I'm going to roughly estimate, based on other data, that it's going to trade 10 to 12 times that volume based on the pre-market volume, which means that 220 million pre-market times 10 or times 11, 12. It's roughly 200 to 240 million dollars volume on the day. Now, if you times that by its opening price, which says $10, that's 2.4 billion. Mm-hmm. So when I'm looking at this pre-market, I can calculate roughly and approximately how much dollar volume is going to trade on the day. Then I can categorize it into one of these clubs or categories and say, I've not seen this fail before. It should be a long. Look for the double bottom. Look for the high or low. Or I am not shorting this under any circumstance because I've not seen one of these fail in over a year.
Yeah.
So I'm basically predicting, because you can't predict the volume exactly, but you can say based on pre-market volume, it's going to be 10 to 12 times. It's going to open at this price, so I'm going to times it by that. You can forecast dollar volume and then categorize the trade and know the percentages of your success based on the last few years of tracking. So specifically dollar volume, just to show you some examples, WIMI, the type, when a stock catches this kind of volume, you tend to see just big runs. We also just
look at that beautiful day. Look at that beautiful
SPI.
Day too. Back up.
Beautiful day too as well. Now, not everything is exact, and there's no exact science to the market, as Tim Sykes always says, but you can generally see trends based on dollar volume of how stocks perform, because the less dollar volume or the less volume, the less supply versus demand. which means the less strength the stock has, which means the less it can run multiple days, or the less it can hold up on the day, or maybe if it's got really light dollar volume, which we'll come to see, the sooner it will fail on that day. We're even talking pre-market here. So with this super strong high dollar volume, $1 billion+ volume on the day, you start seeing crazy, crazy things like this. You get the runs from 2 to 45.
Yeah, and this is Kim. I don't remember. I'm not sure what. Go back to SPI. Yeah, I'm not sure what order the podcast will publish in, but I'm guessing the Nikola episode will come before this episode. And it was funny because I don't know if you remember from last week, Kim, but Stephen and I were losing our minds when the stock was like at 17 and 18, and we were like, we were like, this is insane, this is madness. Meanwhile, we end the podcast, and an hour later, it hit 46.
Yeah, and if only I'd paid those $700 for that, those 100 shares, I would have made some okay money. And I haven't saved every example, but you've got the likes of Kodak, KODK, AYRO. There's quite a few examples of these. But the most important point that I want to illustrate is that we see a lot of these hold. Say 1 in 3 go with this dollar volume, and maybe 2 out of 3 hold, but nothing fails. So it's a relatively safe strategy to be buying the double bottoms. You see how you've got these long periods of consolidation in the 5s on SPI. You've got some sort of, it's hard to explain, but you've got this kind of inverted break. There's several double bottoms. There's several VWAP reclaims where you could have bought SPI safely, and you've got the data on your side. But then is MCRB in the same? Yeah, and McRib as well. I've included McRib, 4 from 32. So when you get this $1 billion volume, you get these crazy runs. And McRib is an example of one that's held. You've got this crazy pre-market push. You've got the 20s to the 30s, and then it just holds all day. So you can see it never drops below its opening price. Do you know what I mean? It always holds it within 5%. I've seen that with every single $1 billion stock that I've traded. So it's quite an interesting.
And then what happens with those is then, that's where, there's multiple ways to skin a cat, as they say.
Yeah.
I love that with McRib. See, what I call that afternoon action with McRib, that's just torturing the shorts is what I call it. And I've been there more times than I can admit, but it's just like every pull holds. And these are the ones that get wild in after hours, or in McRib's case, I think it was the next morning. It blew everybody up the next morning. But
yeah, you can just
two things, if you're short these things and they refuse to break down in the afternoon, man, you just got to take your licks and walk away, because after hours pre-market, now they'll typically fail, but not before they blow you up in after hours or pre-market,
But I mean, it's ultimately, and the reason they don't fail is because there's too much demand, there's too much volume, and then it's a hypothetical where people are like, well, everyone knows there's too much demand, so they don't cover or they don't sell because they know there's too much demand. So it's almost a self-fulfilling prophecy.
And that chart, Stephen, was how many days did it continue to hold?
McRib, I don't know. Tim Bohen might be able to tell you. I was just thinking the same thing. I was like, I wonder if that one come down, because LUB, that fast food company, that's breaking out now to new highs.
Guess what? Take a guess, Stephen, at what McRib is at today.
12.
29.
Is it really? That's
Nothing
insane.
dies. It's 2020, man. I don't care how terrible these stocks are. Nothing dies. It's like you can keep pumping bullets in the back of the head of these piece of shit stocks. It's like The Walking Dead, man. It's getting ready to break out. This thing might break 30. That would be, actually, if it closes at 29, it'll close at an all-time high 2 months later.
Yeah, and it'll probably go high in LUB and TUESQ. And
no volume. I mean, it's just
JKS,
300,000 shares traded, but yeah.
But the whole, like, WKHS, JKS, TUESQ, LUB, MCRB. I can name like 5 off the top of my head, right? That are just holding, that shouldn't be holding.
So Stephen, if with what just happened with McRib, is that something that are you advocating that people use this kind of technique or vision to get some back. The rooster's back, by the way, if a new
No,
rooster.
I mean, look, if you're a long,
Yeah.
I mean, it depends on your strategy. If you're a long and you see something trading based on what the data we've saw so far, if you see something over a billion, potentially over $1 billion dollar volume, I would say you're in relatively okay territory to look to buy those double bottoms.
Yeah.
Look to buy those high lows, to look to buy those VWAP reclaims.
But
And
would
if
that
you're
be
short, I
something
probably wouldn't short.
you would do? Like, so now you just asked him, what was it at? Do you regret that you didn't like hold on to this one?
No, I didn't even, I don't think I touched this. I might have tried to take very, very small size because of the gambler inside of me, but it's a no-go. If there's that much demand, the price can only go higher. And that's the kind of the crux of everything. But I just want to show you guys some differences now. So if we look at the stocks that don't trade $1 billion plus, but trade from 500 million to $1 billion, the data and the pattern starts to change again. We don't see too many of these. I haven't recorded too many of these. The numbers come later on. But we see a 37% gap and go, 37% gap and hold, but only 25. But then we see 25% start to fail. So we start to see as the dollar volume starts to decrease, but it's still pretty high. We start to see stocks coming down a little bit. Or if they don't come down, they're not quite as strong as we initially saw. So with the likes of VBIV, if you compare VBIV to McRib or SPI, you see that because it's got lower dollar volume, it will have that push sometimes, but it can't really hold its high with as much strength. It's kind of the same thing with Pixie, probably one of Tim Bohen's favorites. PIXY, you'll see the push in the 4s and the 5s and the 6s, but generally it might hold, it might fail. You don't tend to see as many of these run. Which brings me more to the more commonly categorized stocks. A lot of stocks, most stocks will fall into the 250 by $500 million volume. And now, do you see how the tables are starting to turn? We're starting to see most of the stocks with 250 to $500 million volume, most of them actually fail from the open. 57% fail from the open, whereas 35% hold and only 7% will go. So if you're buying a stock with 250 to $500 million volume as categorized, you're talking like 1 in 10 will finish 5% higher compared to like a significantly higher percentage on the 500 to $1 billion volume. And we start seeing stocks like maybe VIV, they'll have a push at the open, but they'll tail off. And that's one of the more common.
Oh, jump back to that. I want to go to your first chart, would you? On
this one?
On VIV. Yeah. Okay. Yeah. Yeah. I mean, geez. Yeah. It's just beautiful. I mean, you get that. I mean, and this is where you need patience, but I mean, you get that big wick, and then a candle closes, next candle closes red, and then you've just got lower highs the entire day. So, I talk about the 940 rule all the time on the long side, but man, if you can just wait 10 freaking minutes, you see so many of these when they set that top, you get that first red 5-minute candle. Well, you got 15 minutes, but the first there probably was a first 5-minute red. And then it's just lower highs all day. And then it gaps down the next day. Beautiful. So,
yeah. And I mean, look, like as any good scientist would do, you try and you prove something and then you immediately try and find flaws in it, right? That's the best way you can be a data scientist. And I thought when I first found dollar volume, I found the percentages over a couple of hundred stocks tracked. I thought shit, I've cracked the key to the stock market. And then I realized I started taking big losses. So dollar volume is only one variable. It's only part one of a 10-part story. Because like VIV, you can say, oh, it falls into this dollar category. Maybe 50% of them fail, or only 1 in 10 of these kind of stocks go. But you'll also find that the volume, the 250 million volume in relation to its previous chart history is massive. And I've seen tons of these run. So what I've actually found more importantly is that the dollar volume in relation to the rest of the daily volume on that, say, 1-year chart is more important than some of these stats, to be honest. But the stats are not lies. Do you know what I mean? The stats are the stats based on data. And when you go to 150 to 250 million, you start seeing that like
and that's
1 in 4,
interesting.
1 in 5 fail. Yeah. So I just
as
want
a
to
dork, I love this. By the way, I'm as a nerd, I love this. I love how lopsided your bar graphs are. You know, it's like we start out at Billionaire Club, and it's the exact opposite of the 100 to 250. You know.
Yeah, and look, it just makes sense. I mean, you never want to be swayed by data. You never want to be biased. Price action is always trumps. And I think one of the guys, Jack Kellogg, said it. He says, look, use your data to find your stocks, but then use price action to trade them. And I thought that was a beautiful thing, because I think, now look, if it trades $1 billion in dollar volume, I think I'm not going short of that. It's stupid. But if it trades 150 to 250 and it's got maybe some bag holders and it's in a weak sector, I'm thinking, perfect. It aligns with the dollar volume. It aligns with the volume on the daily. It aligns with the float. It aligns with the sector. It's just about having like strong confirmation on dollar volume. I guess this is what it's about. So yeah, 73% fail, 23% hold, 4% go if the ones that I've tracked. So pretty much 1. And you start seeing, instead of seeing stocks with the $1 billion volume just ramping pre-market and then pushing, then maybe with the 500 to $1 billion or 250 to 500 million, those kind of push and hold, or they'll give you a bit of trouble during the day. Once you get below like 100 million, you start, not all are the same, some push on light volume, there's those exceptions, but you start seeing pre-market failures because they don't have enough dollar volume to sustain themselves even through the opening, because where with the $1 billion category, demand outweighs supply. With the 100 million category, you start seeing supply outweigh demand. So you start seeing the opposite effect, and you get the fails like DPW. This is even lower again, and you start seeing stuff like LONE. So when I see this light volume, and then I see a terrible chart, and I see bag holders, I know that there's not enough volume on the day, and there's not enough dollar volume to compensate for the bag holders who are going to get out. Therefore, it's going to start failing pre-market unless something crazy or unexpected happens. And that is the presentation.
You got to share this with us, right?
Yeah, for sure, absolutely. I can share it with you guys. But
now, one thing I always try and obviously, well, we all work for StocksToTrade, but one thing I will say to everyone out there, I always try and kind of avoid the sales pitches. But that's the great thing about the screener in StocksToTrade is you can get really granular. So while we're sitting here, I ran a scan for a low float stock traded over $1 billion in volume, and you've got ASAN, which is a Sana, which actually we use every day at StocksToTrade. It's an IPO. Okay. It's a day one IPO, but it's traded over 50 million shares at $30 a share. Yeah. And I mean, it actually just broke the high of the day. It IPO'd about an hour ago. I mean, you can find these types of stocks. I mean, and IPOs have been hot. You can find these types of stocks with all the screeners, and you could have, if you copy Steven's template, he had names for, you could have a billionaire club screener. You could have a 150 to 250. And the great thing about them is you can have all these screeners running, and you now know, okay, here's one that's trading the dollar volume in the range I want. It's got the float I want. Then then ultimately you got to look at the chart and you got to review it. But that's, use the power of the machine, which is, StocksToTrade to let you get as crazy granular as you want. So
do you guys think that that sort of data tracking is critical to anybody who's going to be successful as a beginner trader?
I think is, like I mentioned, it's so let me start over. Yes is the short answer. Okay. And it's interesting because, even presenting all these well done slides that he's put all this time into, and I'm like, oh yeah, I remember that one. Oh yeah, I remember that one. I remember that about, I remember SRNE, and so at some point, a lot of it is just in your brain, but especially when you're early, you don't know what you don't know. I mean, you don't even know what you're looking for. So, I mean, I remember I shared my notebooks before. I used to just track everything. I'd save charts, put them in binders, because what you're trying to do, and I think a lot of our guests would back this up, these stocks move fast. You know, you've got to get through that OODA loop, as they say, if you're familiar with the observe, orient, decide, and act loop, you know, and the more repetitions you do, the more tracking you do, the faster you can get through that OODA loop, which is developed by jet fighter pilots. And I don't know how you do that without doing the type of stuff that Steven's doing, or it just takes you way longer. I think by doing that data tracking, by looking for, trying to find things. I mean, I don't want to ask for Steven, but I'm guessing it was kind of exciting when he was like, whoa, you know, and I think that's part of the learning process. So
how did it come about, Steven? Were you just tracking data?
It always just comes from asking questions, and that's the best advice I can give to any trader. You've just got to ask questions to yourself and say, what's different about this stock than every other stock? Well, immediately obvious is like, wow, there's loads of volume. And then the next question you would ask yourself is, does volume influence stock price? And then logically you would think, yes, but I need to empirically prove it.
Yeah.
And then you start thinking, well, I wonder if this stock volume makes stocks move different to this stock volume. And then you just ask question after question after question. Then you think, how does this, how may volume relate to float? And is there any nuances or outliers where volume doesn't matter? So for example, I started finding that very light volume pre-market can cause stocks to rip. Tibble, no PED. Do you remember PED?
Yep.
Last month, very, very light volume. They just rocketed that from the open.
Wow.
But yeah, it's about just asking question after question after question. And it's like, how do I get profitable? Well, I need to find a pattern that's profitable. Well, which one do I see going up and which one do I see going down? Which stocks do I see running and which stocks do I see failing? The ones that are running, why are they running? What do they do before they run? What's the safest entry to buy when they run?
You know, and this is probably more of Kim's specialty, but man, I think great job. And I think the biggest takeaway, you nailed it, is that asking yourself questions thing. I mean, I just talk with a lot of newer traders because of what I do, and people don't do that, man. They don't like question themselves, and or they don't try and dig deeper. You know, they just, they show up every day. They buy the big runner, with no plan, no checklist, no process. Then it works and they're like, woohoo, but they don't ask the questions. And then it doesn't work. And then they blame, they blame the news, they blame the market makers, they blame something, but they don't ask those questions. And man, that's a great takeaway. I think that's the title of the podcast, I think.
Curiosity. That is the key.
Yeah.
That is the key. And Steven, do you think too that you're like, everybody has their lens, right? I really feel everybody has the lens with which they see the world, with which they see trading. So do you think that there's a certain lens that brought you to notice this? Like, of all the things you're probably tracking, what do you think was the reason this one stood out to you?
No, well, I mean, I was just looking, I thought, look, what's the most common pattern that there could be that I can play over and over? Because if I want to learn a pattern, I want to learn the most common one that I see the most. Because I don't want to learn a pattern and then trade it once every 2 months. Right. These gappers, if I could just find a way to learn how these gappers, which ones go up and which ones go down and why. So I just started asking questions, and I think trading is the most inquisitive. I mean, it's like, I don't know, it's one of the most inquisitive disciplines there is, because it's the one where you should ask the most questions the most times.
I think it's, I think I've called it this. I think it's like, for lack of a better term, it's like poor man. It's like poor man science. Okay.
It is,
I can't do, I can't go work at SpaceX. Okay. Elon ain't hiring me. Okay. Hey, listen, I'm handy, I know how to solder. Okay. But I ain't working at SpaceX. I'm not working at Tesla, or I'm not helping develop a coronavirus vaccine. All that stuff is way behind beyond my Cro-Magnon, Neanderthal abilities. But what's great about trading is anybody can do it. I mean, you've got, again, whether it's StocksToTrade or there's Thinkorswim, there's a million platforms out there. There's a million different screeners. You get a spreadsheet and you can start doing some science. And if you love this stuff, that's what I bring up all the time, man. You got to love this shit. And you can see it with Steven. I mean, he was doing this stuff in his free time, because he was curious by it. He brought it to the podcast because he wanted to share it. He wasn't getting paid to do it. He wasn't, it's not, he was intrigued. He was excited by it. And that's how he came apart this thing. So, and that's what I love about trading. You can be as scientific as you want. I mean, we've had ducks on the podcast before. I mean, geez, you want to talk about scientific approach to penny stocks? I mean, he's doing SpaceX stuff on penny stocks.
Ducks should work for Tesla.
He probably could.
But I mean, what I showed you guys is a very small preview, and to really get to grips with things, you've got to do this kind of research on all of the variables and on all of the different patterns. So it is a lot of work. You've got to kind of love it, and you can't also be too swayed biased by your data, because sometimes overanalyzing data can make you make mistakes. Because there's intuition and there's data, and intuition and data should work together, right? But sometimes one outweighs the other, and it can get you in trouble.
Well, Steven, I would like to thank you for bringing this. This was your idea. I love it. Again, as a nerd, I love seeing this kind of stuff. And we get asked about this a lot. I get asked about it a lot because, we'll say this in episodes, all the time. Track your data. Excuse me. And a lot of people say, well, how do I do that? And I think this was a great example.
Yeah. Pick
a variable, one variable. Again, that's the scientific approach. Okay. Again, I'm no scientist, but I know that the first thing you do is you focus on one variable and you try and repeat that. If I can turn water into wine 75 times successfully every time, well, I now have the secret for water to wine. If I turn water to wine once, I'm just Jesus and I got lucky, but so but that's the way you do it, is track this stuff, look for readability, and focus on little things. So
I just love the fact that you did this, Steven. Like, you are being autonomous. Like, you've been learning from Tim and Tim Sykes and all these people, and yet then you said, well, what am I going to do? And I love that autonomy, because that to me is part of maybe what some beginner traders are afraid of. Understandably, I would be afraid. And honestly, I don't know if maybe you can afford to go into that autonomy. You guys tell me if I'm wrong, but maybe you can't go to autonomy for the first 2 or 3 years. Like, maybe you start to go to autonomy where you try to find your own, those patterns that make sense to you, or that you're seeing over and over again after you've been doing this 2 or 3 years. What do you guys think about that? Am I right? Or
yeah,
is autonomy important?
I've always said, and I'm sure Tim will back up, I've always said that you need, probably most people, unless you're an absolute genius or you're highly, highly, highly intelligent, like Tesla style, vast majority, 96% of people, 95, 94, whatever, should go through some sort of educational package. Like, I would have never made it profitable unless I've been through the courses.
Well, I don't want to say you never would,
but it would have been tough.
I think you'd be 4 years in where you are and be way further behind where you are,
Yeah, you absolutely need to see other traders and how they trade and what they're doing and the why of what they're doing. And the explanation, and obviously you can get that in the challenge, StocksToTrade Pro, whatever other course. Like, you need to see how different people trade, and you need to be taught the whys behind it, and then eventually you start thinking, you develop your caricature and your personality of how you want to trade. Then comes the data, the analysis, the practice, the repetition, the charts, and the learning from mistakes.
Yeah. I think just what Tim said earlier about those who are not asking themselves those questions, that worries me, because if you just think you're going to be able to get the answers all the time from somebody else, I think you got to have a little bit of that courage to be like, okay, I've done the work, I've been studying, I'm looking for the patterns. And at some point you have to make the decision. You can't like be always asking somebody on Twitter, let's say, or in a chat room, is this what I should do? Like, you have to be willing to kind of make that mistake even.
But that doesn't work. Like, say, for example, Tim Bohen, every morning on StocksToTrade Pro, you'll outline the dip and rips. And that's cool, and that works, and that gives a basic familiarity of what the pattern looks like. But I think the next stage is for people to say, I'm going to track every single dip and rip and see which ones work and why, and what my preferred entry is. Is it the high of the day? Is it the 2 p.m. afternoon? Is it the double bottom at 9:40? Which one do I see work, and which one am I comfortable with?
But that's work.
See, that's it too, because a lot of these, a lot of, the pattern, you got to find setups that work for you too. Again, Steven has developed this style where he's 90% short. I used to be 90% short. You got to find styles that work for you too. So it's like, there's a million different patterns, a million different techniques, long, short, high price, low price, crypto, Forex, whatever it is. And you got to find what, because it just might not fit your personality. I know that might sound weird, but some of these things just might not jive with you. And that's why you got to track it. So,
but look at Tim Grattani. I mean, I remember watching a webinar from Tim Grattani. It was like 99% short. He could not long for shit. And I'm seeing webinars this year where he says he's made more money long than short. It just stuff started clicking for him, and he started tracking the right things. And even for me, you change as a trader, because I used to be shorting heavy pre-market and heavy into pushes. And then like I made a 1K trade on a first red day the other day, and I thought, that is so much easier than fighting with these top percent gainers on day one. That first red day, because you've got you've got the red green level on the previous day, Tim will know, and you're basically just shorting off that level. And I thought, this is ridiculously easy compared to fighting these gappers and working which one's going to squeeze. I was like, what have I been doing for 3 years? So you get safer and safer. There was a quote, right? There was a quote from some guy, Spiros, I can't remember the name of some hedge fund guy. And he said, what he'd like to do is have a rookie with a veteran, because the veteran would be safe, but the rookie would have the kind of the crazy ambition, or the balls, if you like, and the figure each other out, and they'd be a good team.
Fascinating.
But I'm getting a cautious trader. I don't even like shorting these gap and craps anymore. I'm done with them. It's too dangerous.
Say that again, just to make sure I'm not hearing things. What did you say?
No, honestly, like
meanwhile, he shorted ITRM an hour ago
and got squeezed as well. But I didn't add to the loser. I just sat there and prayed.
Well, guys, I'd like to thank you. Thanks, Kim. And thanks, Steven, for putting this together. As always, drop us a comment. We're always experimenting. When this was Steven's idea, and he's like, what do you think about it? And I said, let's try it. Because again, people ask about tracking data. So this is a little bit nitty gritty. If you're on iTunes, I would definitely suggest jumping over to YouTube, because I think we talked the way through it, but Steven did have a bunch of charts. He had his own charts, like some bar graphs. He had some statistics, and then the actual stock chart. So I think we did a pretty good job of relaying what we were looking at. But head over to YouTube if you wanted to kind of actually see his slides. He did a whole slide deck. And as always, drop us a comment. What do you, the listener, want out of the podcast? Kim, Steven, and I love doing these. We have a blast with them. But there's a million different things to talk about. And interviews or breakdowns, recaps, chart patterns, books. There's a million things to talk. We want to do what all of you want us to do. That's why we're here. So to give value back. So thanks again, Kim, Steven. Thanks again to everyone out there. Any links, etc., head over to steadytrade.com. Everything will be linked in the blog post, and we'll see you next time.